Good morning, ladies and gentlemen. Well, the market has backed off as we thought it should because it offered absolutely no value, no return on investment. And so what happened last week? Well, we went from, mildly positive to mildly negative. If we look in the daily model box, we'll see that the scores basically, went slightly positive and then ended the week slightly negative. The differential between the two MAs is still coming in. It's coming in very slowly, which to me indicates that the market is actually going to meander about. Uh, the same situation is evident in the weeklies. It's still, even though the scores changed very slightly on the week from +1 to -4, we are still coming in on the moving averages, and the same is true on the monthlies. You can all see this on the wrist dial, and I'll leave it to you to have further insights. If we look at deviations, well, it's backed off from the red area and it's coming back in towards the center line. Center line, as you can see, it's right around 2900 and is rising. That to me indicates that anything between the levels that I will show you later, which are 2954 and 2864, is basically a buy for a bounce. It's very interesting now that we are seeing this rapid coming in of the bands, and they will be coming in all of next week, I'm convinced, indicating to me a smaller trading range for the weeks ahead. If we have a look at the individual sectors, you will see that this is evident in nearly every single one of the big sectors. Same picture everywhere, contraction of the Bollinger Bands and a rising center line, indicating to me that the market is going to test supports, but it will most probably, the risk reward is that it will hold those center lines or just very slightly below. I don't see a single sector, especially the big ones like XLK, giving us too much trouble. We could do an A, B, C in them, but they will still hold the center lines, and XLF is the one that backed off from the very overbought situation it had. But even there, and that is one of the weakest sectors, we have the center line, the rising center line as support, and these Bollinger Bands contracting, telling me that we're going to have smaller and smaller ranges. Why would we have smaller and smaller ranges? Well, because of the indecision of where we are at the moment. Now, I have no idea how many days it's going to be before we go back to a normal economy and we have the range of full forward earnings that we are expecting after the COVID crisis is over. Everybody is still expecting somewhere between $150 and $170 in earnings in about a year's time. Let's say that that is 400 days as I have it here. It really doesn't matter very much whether we say that that is even 500 days. The yield differential is not that large. I would argue that a multiple is never going to be much lower than 18 because the bond yields are so low. So even if we go for probably what is the worst combination of 28 of 500 days till normal earnings of around 160 with a multiple of 18, we're still coming up with a terminal price of 28.80. Now, naturally, against 30.35, that is a negative yield, but against 28.64, that is a yield of approximately zero, so I would say that that is probably as bad as we get at the moment. But that multiple really is too low for the bond yields that we have at the moment. I would argue that 20 is a much more reasonable multiple to have against 500 days and $160 of forward earnings, and at 28.64 that gives you a yield of 7.5%. 7.5% in this market with no yield anywhere compared to 30 years where they are. That is a very decent yield, and that is why I keep on saying that 28.64 should be very, very good support for the market. And even at 29.55, we're not at ridiculous levels. We are at 5%. To me, that is probably good enough, and that is why I'm going to tell you that between 29.55 and 28.64 is where the support of the market is going. If we look at what the yield curve is telling us, I'm sorry about this chart, I don't know what happened here. We actually ended up here at 51 basis points. I'll have to get a better charting package than this one. It's basically telling us that we tried to go full risk on, it didn't work. It's come back to within this trading range of 53 basis points down to 35 basis points. And that is the neutral range at the moment. This is where we are saying, yes, we don't know what's going on. We don't have that much forward visibility. It's too early to have a forward visibility which is up towards 70 basis points and a very positive yield curve which indicates that everything is great. The Fed is just holding the 2-year where it is, roughly at 20 basis points, give or take 5 basis points, and the 10-year can steepen, the 30-year can steepen, everything else can steepen, because the economy is going to be doing much better going forward. The market is saying it's too early for that. The visibility that we have is still for a range between 53 and 35. Only if we see the market going below 35 and below 30 basis points, then we are in trouble. Then we are talking about return of investment and people being scared they will never see their money again, as opposed to investing at a yield. And that actually will, I will argue, will use that 28.64 level as a swing level between people wanting to get a return on investment as opposed to being scared of never seeing their money again and panicking on the downside. If we have a look at what the 10-year and the 5-year are doing in Germany and these trading bands, we will see that we've come back into the minus 40 to minus 60 range on the Bund, and that is really what I think is a reasonable trading range for the Bund for quite some time. When we get more risk on, we go up towards the minus 22 area, and the minus 22 area is going to be the swing level for the rest of the year. I'm pretty convinced of it. When will we know that the market has discounted that we are out of a crisis is when we start trading and closing above minus 22. Until then, we're in a big trading range with minus 22 and minus 60 is the trading range, with basically here at minus 40 being the swing level between slightly bullish and slightly bearish. I don't see this moving for quite some time. If we look at what is happening in the bubble, the shorter end, I think here at minus 68, minus 69 basis points, it's going to be a very good swing level to look for less negative yields. There is absolutely no reason for to panic at the moment. Only if we start breaking through minus 68 and closing in on these lows will there be any indication that the market is turning bearish on risk. At the moment, that is just not the case. We are swinging from slightly positive to slightly negative, and to me, this minus 68 level is going to be a good level to look for at least a move back to this line of minus 61. The 530s also backed off for the week. You know, it's unreasonable to expect that we will see this minus 154 basis points any time before the end of the year. To me, 154 basis points is we are out of the crisis. We are, everything is fine. There are no problems. The yield curve can be steep. It's more likely that we will trade around the 100 basis points mark right here for quite some time, maybe go back up to minus 80 basis points and allow these moving averages to turn. Restaying in here is more likely to me than just a quick bounce and then a collapse down to 154. If you think about what 154 basis points means, you know, the 5-year is very unlikely to go above 35 basis points anytime soon. The Fed has told us lower for longer. Powell was very, very clear, lower for longer, and that means that the 2s and 5s are pretty much stuck. They will not do much worse than they are at the moment. That would mean that the 30-year would have to take all the strain. So if you're talking about 30 basis points for the 5-year, at 154, you are talking nearly 2% on the 30-year bond. Well, that would have to be a very, very bullish scenario for risk. That means that people are not afraid of buying risk in the slightest, and that basically everything is fine. Too early. We are just too early. There are too many unknowns out there. So I think it's much more likely that we'll trade back to 100 or even 90 or even 80 basis points and allow time to pass and basically to have a much more clearer picture of the future. Now, one of the most striking features of last week, I thought, was the fact that gold did almost nothing. Now, it improved slightly. You know, it went up by $30-40, but it had an open goal. It had Powell saying lower for much longer, and it had a very definite risk-off week. It had every opportunity to really break the highs of the previous week, and it didn't. Basically, it had an inside week. This is a weekly chart, and this here is a monthly chart. Basically, 1764 is holding it on the upside, and 1658 is the support that it's still holding on the downside. It's here on the weekly, it's 1667, but you know, it's the same thing. Why are people not buying gold? And why are people evidently not afraid of return of investment? Now, gold is something that you buy when A, there is no yield, and B, you're afraid that you're not going to get your money back in anything else. It's the ultimate cash. It's the cash plus inflation plus safety plus momentum plus whatever. And it's interesting that nobody really is afraid of that at the moment. I'm not saying that that is not what's going to happen in the end. I have no idea. I have no idea what ultimately will happen. All I know is that it didn't happen last week when it could have happened and probably should have happened. Now that made me look at certain other spreads, which I will now share with you, and really we are coming up with some pretty good tools to determine when people will start panicking, or the people are panicking and worrying about getting their money back at all, as opposed to getting a decent yield, as I showed you in that Excel sheet, on their investments in risk. If we think about it logically, there are only really three investment classes out there. There's bonds, and this is a chart of gold against TLT, and there are risk assets, and this is a chart of SPY over gold. Now, if we are afraid of getting your money back and or inflation, gold is going to be a better asset class to own than bonds. Bonds, even though the yield is so low, offer a return, while gold offers no return. And if you think there is going to be growth, you will have an investment in risk as opposed to an investment in the cash that represents stable cash that gold represents. What has been happening in gold against TLT? Well, very, very, very little. I suggest that this line is going to be our tell when, if the market is more afraid of getting its money back at all rather than getting a yield, and that this line is the line between investment in risk and investment in panic. We are close to them, but we are nowhere near ready to break them, I would argue. So gold is at the moment being pulled in two directions. The direction that the bulls would like is not as strong, simply because there is no reason at the moment to think that the Fed is not going to be successful. It's too early to say that we are going to have a move from the current situation where liquidity is the problem, as opposed to solvency being the problem. If we get a bout of severe risk off, that can only be because people are now afraid of solvency issues as opposed to liquidity issues. And that is when I say that gold is going to break up from this line and below this line. We are a long way away from that, and that is also what makes one think that people are still looking for return on investment as opposed to a return of their investment. Another great indicator of the difference between people being afraid of not getting their money back and placing it at a yield, I think, is 43.05 in the VIX. This is the weekly chart and this is the daily chart. I think from this one you can see that we are nowhere close to being able to break up through 43 and stay up above 43. We tried to break decisively higher above the Bollinger Bands, and we couldn't hold it. And at the close of the week, we went, and closed right on top of the Bollinger Band, which will not be rising very fast on Monday or Tuesday or Wednesday. So it's just too early. I would argue that you would need to see closes above 43 for the market to really start panicking and saying that even the yield that I showed you earlier that you're getting at 28.64 is not a decent yield, because I'm more afraid of never seeing my money again. I think it's very unlikely to happen. I had offers in here on the front 2 month contracts on Friday. I didn't get filled. The market just collapsed nearly 5 points. in a couple of hours. I think we will probably see this level again, and I might have more luck, but it's only if you start closing above these levels, that this very important 4305 line, that you get a real panic. To me, anything between 37 and 43 is a sell for a return back down to 23. As simple as that. This is very much putting it in a different way. Let's put this in words. Okay, we are in a period of risk on. We have forward visibility. Things are pretty clear. This is when we start going into full risk on, basically October of 2019. The trend is basically very strong. Here we have the first indications of the COVID crisis. Oh, it'll be fine, it'll stay in China. We continue with it. Oops, it's not staying in China, it's coming here, all the way back down to 28.64. Maybe it's now oversold. We bounce back to 31.27, and then yes, we are very, very afraid. The markets are stopping working. We gap below 28.64, and we keep on going down until the Fed comes in and basically says, here, have all the money you want. We will not let this turn into a solvency issue. And what do? We go straight back up to 28.64. We meander around 28.64, and then for whatever reason, things are going to be fine, and we just explode higher, and we have no yield, right? We have absolutely no yield at 3,200. It's like saying everything is going to be perfect, and we're going to have multiples, not only 20, but we're going to have them 22, 24, and there is no chance of a second wave, and we know exactly who will be elected in November and what the policies will be. Wrong. I mean, absolutely wrong. Market comes back, probably now does some sort of an ABC, and rests between 28.64 and 29.54 for an extended period of time. It could do this. Okay, and this makes perfect sense. This is from basically July until October. I really don't see now the market returning above 3,200 until November of this year. Too many unknowns, too much uncertainty. Why would we do that? I would argue that only below 28.64 do we have problems, and I like the yield at 28.64 of around 7%. If that is no longer a good enough yield, and it is, then we are talking about bringing down not only the multiples, but also bringing down the earnings that we think are going to be the full earnings when we come out of the COVID crisis. And $160 is not unreasonable. Then we are talking about having earnings of $120, $130 for the index, and in that case we are down here. We are down in the 2200s, 2300s, that kind of area. But it's far too early for that. Why would we go from everything is going to be perfect to everyone's going bust? It just doesn't make any sense. To me, the highest probability trade is now that we trade between 28.64 and 29.54 as a bottom, retest the 3100 level, meander between the two for quite some time, and then we will see. Much the same story can be told in the chart of the Russell 2000. To me, the real line between stability and disaster is this 1287 level, give or take a tick or two. I think any weekly closes now below 1287 are going to be problematic and are going to be worrying. But as long as it stays above it, and we are a full 100 points above it, was that 6-7%, we are just fine for the time being. It's normal that we overshot, and it's normal then we might undershoot a little bit, but as you can see, this level is somewhere between the 38% retracement, and I can enlarge this area, somewhere between the 38.2 retracement of the whole move down and the 50% retracement of the whole move down between 13.19 and 12.52. So we could have 12.52 down as a intraday, but I think as long as we keep on closing the week above 12.87, we are just fine. Much the same story for DAX and stocks, and I like it when everything comes together towards the same level. I would argue now that first, we didn't get a bearish engulfing candle, neither the S&Ps, nor the DAX, nor the stocks. We had the opportunity, we didn't take it. Now, what does that tell me? That tells me that dips down to 11,400, that's 11,398, who cares, 11,400. And here, let's say, at no worse than this, call it 3,000, 29.95, something like that. This probably won't hold if the S&Ps go down. But here, 29.84, I'll put a line in there. These are really the maximum retracements you should be comfortable with. Let's put him here, 29.70-ish. That is really about as far as you wanted. You want it somewhere in this box here, and that should be a buy for a return a little bit higher, and here 11,400 for a return towards 12,000. It's more or less all saying the same thing. We are going back to an area of value, an area of yield, and we will not be worried about return of investment anytime soon, because I think the central banks and the market recognize that the central banks still have our back, and it's far too early to say that they will fail and that we will have a period when we are worried about not only liquidity but also solvency. Far too early to say that, and therefore I see absolutely no reason not to buy in that 28.64 to 29.55 area. Want to leave you with a few words on the dollar, which basically has been everyone's bane in life, simply because it will not get into a trend. It's been so annoying, it's just not true. I would now argue that if I'm right on what I've just explained to you about the value areas in risk, that we will not break 98.54 to let's say 98.33. Between 98.33 and 98.54 is the value area to short the dollar. It's quite obvious the dollar is moving in reverse to risk, and it also quite obvious that if we get to the 28.64 level, that might coincide with the 98.54 area, 98.33 in this chart, and that will be a very, very good risk-reward area to look for it to come back towards this 96.50 area, which has been such an important area throughout the years. Really, it's held for 2 years. So now I think selling at 98.33 to 98.54 or buying some puts there is going to be a decent risk-reward strategy for a return down towards these levels and the weekly Bollingers and the low of the weekly Bollingers. Thank you very much indeed, and tweet you on Monday.